go, exactly on time. Thank you for joining us, everyone, for the first market call of, what's it now, 2024. It already feels like we're 4 months in. So we are glad to have you here. We're all together in the Pretoria boardroom. And today, like always, we'll just give it a minute or two. We know that some people might be running a bit late. We've changed some things up at the market call. You'll see you have a question and answer tab now at the top of your Teams, and you can create a post there and then ask us a question. If you have a question, we'll see how this works, and if it works as good as we hope it will work. What we are going to start discussing, we had a lot of conversations in the team about the market call and what we're trying to do with the market call. And the idea is still that we give you as the advisor and then some of the clients that are joining us as well, some insight into what's happening in the markets, what's happening in economies, and how that translates into decisions that clients and advisors have to make in terms of asset allocation, in terms of the currency. Should we be taking money offshore? When are we taking money offshore? What warnings are there? When do we make certain adjustments to asset allocation decisions? So we're going to try and improve some on the content of the discussion. We're still going to do the panel type discussion. I think it works well. It's a lot more interactive, especially from our side. And I think that increases the quality that you hear on your end. So the panel discussion we'll continue to do. We'll have one host. Today it'll be Renier, and I'll explain why. So we'll have one host, and the rest of the team will then engage in that conversation around a specific theme or topic. The theme for the year is definitely around volatility and uncertainty, and of course global investments. We are going to try and re-educate our clients or our client base in terms of what does it mean to be a long-term investor, what is the long-term, how do you translate short-term volatility or navigate the emotions of short-term volatility. So we'll probably have Carl up again in terms of to speak about behavioral finance. The presentation that he and Christian gave last year, I think, added a lot of value of how you can manage that behavioral finance in your personal finances as well as the finances of your clients. So the theme really is long-term investments, and how do we invest for the long term, and what does it mean to be a long-term investment, and how can you navigate the short-term volatility of the market, and how can you alleviate some of the pain points in that point. So Renier, as you all know, with Etienne, is responsible for the global model portfolio, which is what we specialize in, investing assets offshore for our clients, taking money offshore and then managing it efficiently offshore, and co-creating wealth with our clients. So we thought it just relevant that Renier start us off this year for the market call, because there are a lot of questions, especially this year with all the elections going on. And then next month it'll be someone else. We're also going to try at least 3 of the upcoming 11 months. We'll end in November again. At least 3 months we'll have some experts on. We definitely want Nolan again in terms of the bond expertise that he gives, some equity specialists. And we are even floating the idea of seeing if we can get some CEOs of some of the large firms that we invest in. Obviously not the international firms, that might be a little bit difficult, but definitely for some of the local firms that we are investing in. So without any further delay, I see we have most of our crowd are here. And just for everyone who was a little bit late, there is a Q&A section where you can ask questions. You can put your questions, just start a topic there. I'll start a topic. Maybe I see Martin is saying, weet ons nou al wat Driekus weet? Nee, ons weet, ja, ons weet wat Driekus weet. The assessment did go out. I'll ask Eunice to also send the link in the chat as well, in the Q&A section. Maybe we can see if we can send the link there. But I have received an email this morning. What we're doing now, just so that everybody knows in terms of the CPD points, the process is almost completed in terms of automating the entire process, so that the CPD points will be out in the first 2 or 3 weeks after the market call. The only reason it takes 2 to 3 weeks is because we leave a 1 week window open where you can complete the assessment. And then basically everything gets automated from there. During that first week, we'll also do the application at the FPI to get CPD approval for our market call. That usually takes a week to 2 weeks. So then in the second to third week, you should receive your certificate. It is an automated process. We're just having a little bit of a hiccup with Power Automate that does not allow us to send to 400 or 500 people the assessment or communicate. Francais, that might also be why you haven't received your assessment yet, because it's now being sent out in batches. But I'll ask them to put the link down in the tab as well. So without any further delay, dankie. Renier, over to you.
Thank you, Francois. Let me just quickly put it there. There we go. Azai, 100%. Just please tell me if you can't hear me or if there's any problems with the line, please. So yeah, welcome to 2024. This is the first market call for the year. I hope you guys are just as excited as we are for the year ahead. I trust by now most of you have gotten through all those pesky miles that has accumulated over December and can start spending a lot more time, obtaining new business and building the business for the year ahead. So Francois has basically alluded to what we're going to discuss in this meeting. We're going to have more of an offshore tilt this time around. We've been advocates of offshore investing for a very long period of time. We all know, we've got our assets in South Africa, our house and our vehicles, etc. We've got our businesses here, we've got our pensions here. So it's extremely critical for us to basically externalize some of the funds, at least offshore, and then basically to talk to the experts and decide at what levels on the USD ZAR to externalize those funds at. A couple of reasons for that. We know the after-tax benefits of the peer currency depreciation over time that can possibly happen. It's not always a given over a certain period, but it can happen. And then also the opportunities offshore, as we've said enough times in the past. We've used the examples of locally you can basically only buy Richmond offshore, Hermes, Burberry, LVMH, locally only the likes of Naspers and Prosus offshore, the likes of Nvidia and Microsoft, etc. So, the advantages are basically twofold at the end of the day. By now, most of you already know the team. We're young, dynamic. You can reach out basically to anyone via mail or via phone. The star players in our teams, definitely Eunice and Rihanka, they're the gatekeepers to anything ranging from basically mandates to compliance, to platforms. So we leave all the difficult stuff for them to deal with at the end of the day. But you can reach out to them. Also, there's not a lot of new faces, and you can see there's not a lot of faces that has left. Francois said this morning, basically, if someone were to leave, it doesn't take long for them to return to private clients at the end of the day again, because it's just purely our culture that works. So in this market call, we're going to break it up into 4 discussion points. The first one being what happened in markets over the last several months. So we want to provide you with the ammunition, enough quivers, arrows in your quiver to take to your clients, have insightful discussions with them. So this is always a big component of every market call discussion that we have. Secondly, we use the analogy of the Tour de France and we pull that through basically to the markets. Here we start to take more of a longer term view, and we are setting ourselves up for the next 2 points that are coming. Point 3, basically, what did we buy? What did we sell during the last month or so in the global portfolios? I mentioned at the start, hopefully you guys have worked through those pesky miles now. So we've also been busy since the start of the year. We've already made more than 7 changes to our global portfolio. So that equates to about 1 change every 3 days at the moment. We've been quite active. I'll quickly touch on those. And then just the 4th point, Francois will just finish us off with the financial game plan, for the next 5 to 10 years. And how can you approach this global landscape and do it prudently? So without further ado, just on what happened. So we've seen, on the 11th of January, the US got pretty tired of the Houthi rebels attacking vessels and ships in the Red Sea. They started to attack the Houthis, and they started to cause quite a bit of damage. What we've seen up until now is that the Houthis are slowly but surely been withdrawing from the region. There's been less attacks over the last several days. A big reason for that is because the Houthis are busy with their own civil war at home in Yemen, where they need resources, basically to conduct that war. So we see basically that, even though this could persist, it wouldn't persist on the scale that we've seen it over the last several weeks. Furthermore, I think what the market is looking at, and us also more specifically, is whether this conflict that we're seeing in the Red Sea will actually broaden out into a regional conflict. So, we've seen Israel conducting military attacks in Hamas. I think the big problem will come in if Hezbollah starts to become involved in this war. They're backed by Iran. And I think the worst case scenario that can possibly happen is if you have an Iran-Israeli war or Iran-US war, because that will then draw in some of the regional players like the Saudis, the UAE, and, for example, Bahrain, and that will have a substantial influence on oil prices. More specifically, also what we haven't seen, to date is we haven't seen a lot of disruption in the Strait of Hormuz. Once again, that is where 30% of the global oil trade flows through. If anything were to happen, there it will have much more of an impact, on global trade than what is happening at the moment in the Red Sea. So at the moment, about 10% of global trade flows through that region. And we're seeing that 70% of that 10% has been disrupted thus far. What we are seeing, though, is not a complete stoppage in global trade, at least. We're just seeing a postponement where a lot of these ships and tankers are rather choosing the long route around the Cape of Good Hope. So basically, it takes products a week longer to reach the likes of Europe and the US. Also, more specifically, Europe is disproportionately more impacted than the likes of the US. They've got bigger exposure in this Red Sea. So what we've also seen is that certain products, their prices are starting to climb, more specifically in Europe. You're not going to see it as such in the US, but we are basically monitoring the length that this keeps on going, because the longer it keeps on going, the worse it will get. You also can't really draw any comparisons to 2020 with the type of supply chain issues that we've had, during COVID. This is not on the same scale at all. So there's no need to be concerned about that. I don't know if anyone of the team wants to.
No, I think it's the biggest risk point, the European economy. I think they, like you said, they're disproportionately affected by this. They already came into the year on quite a weak foot, because Germany is almost in a recession, and that's obviously the biggest economy. Germany being very reliant on exports. So we've already seen auto manufacturers in Germany starting to cut production because of the Suez Canal being blocked. Shipping costs from China to Europe has increased more than 300% since the start of that war. So, I mean, like you said, the chance of it being a prolonged stoppage of the Suez Canal is probably not that big. But I mean, there is that possibility, and yeah, I think if there's the biggest loser will probably be Europe in that scenario.
I tend to agree, and I think the biggest winner, Christian, will also be China, because what you've started to see is that China has started to fill the gap to a large extent, that they're sending additional ships carrying large cargo through that area, and essentially getting immunity, from the likes of the Houthis. So it always looks like China is just at the right place at the right time, essentially, which is quite ironic. Moving on, if we just look at elections, what is taking place there, we know the presidential election in the US is at the end of the year. The Republicans, however, have started to push forward their candidates, and they have started to vote on them. Donald Trump is absolutely cruising through these nominations. He's already won in Iowa and also New Hampshire. He's won to such a large extent that the likes of Ron DeSantis, who was the second largest contestant, he has fallen out. He's essentially retired, which only leaves Nikki Haley, as a potential candidate. But Nikki Haley, in her own right, doesn't really have a solid foundation to build off from. So it looks in all likelihood that Donald Trump will likely be the Republican candidate that will take on Biden at the end of the year. I've also seen that Trump's already busy with his tactics. He has his own social media platform that he calls Truth Social, and on that, he's even got to such extent that he's threatened Nikki Haley's donors. and telling them that he's going to blacklist them if he wins the president nominee at the end of the day. Nikki Haley just went to Twitter and she said, no, this is the new funding channel by which they should go through. But it's typical Trump that's taking place there. I think a lot of foreign nations are keeping their eye on these elections. The guys that hope that Trump wins at the end of the day is definitely the likes of Hungary, definitely the likes of Israel at the moment. He's very pro-Israel. And then also India, where he's got a very good relationship with Modi over there. But then there's also other countries like China that really doesn't want Trump to come into power because he's essentially going to increase tariffs by about 10%, which is going to be good for global trade at that point in time. If we look at just the Bitcoin ETF, sorry.
Can we say one more thing there?
You can, of course.
I think you said something interesting in one of our meetings the other day as well, and that's that, what's it, 2/3 of the world now going into elections this year. So I think that's a very important point to bring up in terms of this theme that we have, in terms of the uncertainty that we are facing this year. Do you want to say something on that first before we go over to the US specific?
No, I'll leave it to you.
Okay, so yeah, so I think when you have a lot of voting going on, there's of course one of the questions is this question around is the world leaning more towards a democratic outcome, or is it leaning towards a more socialist authoritarian regime? What we've seen in the past, there's this amazing book that was written by Greg Mills. I think it's Rich State, Poor State, that I read a while back, where he goes to show that the correlation, and the research proves that there is a direct correlation between the more free an economy is, the better it actually does. And yes, you do have your outliers like the authoritative structures in China as an example, but he actually unpacks that to show that underneath the, not in the China's case, but many of these other more authoritarian countries, like you would believe Singapore was to a certain extent, there is this free market drive as well. And I think that's what China is also leading towards, now allowing some of the gaming guys to do what they used to do, allowing people to become billionaires. It's the fastest growing billionaires list in the world is still from China. So it's not just authoritarian to the nature of it's a strong man saying what's happening and when it's happening. They are integrating with the market, and that's what I mean. And as you integrate more with the market, your economy tends to do better. That's why GDP per capita in Mauritius and Botswana, as an example, is higher than it is in South Africa, because those economies are more free or more open than the South African economy is. So I think that's something that we should be aware of going into this, well, basically election year. It's not just a South African and US story that you'll have to keep an eye on, but all this socio-political tension that's basically building up in the world, which really makes the timing the market even more impossible. And that's something that'll push through into the conversation that we'll have later today as well. I just think in general, our feeling is that if Trump is elected, it should be good for markets, global markets. And I think that's more a question I want to pose, Renier.
Yeah.
Do we believe it's good for markets?
Yeah, I think it's going to be twofold. I think, only time will tell, basically, because on the one hand, as I've said, he plans to increase tariffs,
yes,
which can place additional pressure back on inflation to a certain extent. He's more for deglobalization,
yes,
for example, than the Democrats at the moment. That places additional pressure on inflation as well. But on the other side, he wants to decrease taxes.
yes.
So that's going to prevail into consumption. Consumption is already strong, but consumption to a certain extent, has gone over onto credit. So if he reduces taxes, hopefully that can alleviate some of the credit pressure, and then bring that back basically to discretionary spending. And that could be good for retailers, absolutely, for markets.
Yeah.
So to interrupt. Yeah, I think just the game have changed a little bit, or probably we'll realize that the game have changed a little bit with inflation that's emerged now after COVID. I think if you ask anyone, you'll just blindly say that the Republicans are better for the economy.
Yes.
But I think, as you mentioned now, some of their policies can be inflationary. Now, for 15 years since the global financial crisis, inflation wasn't an issue, and everyone just said, yeah, with increasing technology, there's an
Yeah.
automatic sort of down push on inflation that have changed. Now, everyone believes it's sort of under control, but
Yes.
I think disruptions like we see in the Red Sea, that sort of things can now sort of throw a spanner in the works and just delay this rate lowering or cutting or easing cycle. So it's probably not as clear cut this time as it was. I think, to be quite honest, it's terrible to have the choice between those two. Biden 81, Trump 77. If out of 300 million people, that's the best you can come up with. It is quite a terrible thing. I would rather go for Trump than for Biden,
yes.
if I was a voter there. But yeah, and I think the inflationary pressures over the past 15 years, we've seen the Fed, when in doubt, ease to ease whenever in doubt that there was a threat to the economy. They tend to just extra QE and
Yes.
almost overdo that. I think we might now move into a next decade or so that, when in doubt, be more on the cautious side
Yes.
than on the dovish side. So we might just see some of these developments put just a little bit of a break on this easing cycle.
That's very well stated.
And I think I agree. Out of 300 million people, yes, these two guys. But what I've picked up in a lot of the literature and what's been written by real political analysts is that Trump is the guy that gets things done. Now, I think a lot of question marks were raised. If you can read through the noise of what's been said on Fox and CNN and published in journals, is that he does seem to be the candidate that has matured most over his election campaign. So we saw when he came in originally in his first term as president, he was this gun-ho, Wild West cowboy and didn't want to use a teleprompter, said what he wanted, tweeted what he wanted, and he had a very negative response. But you could see throughout that time he was in the Oval Office, he really did mature. The way in which he addressed certain issues, there was a lot more toned down way, a lot more presidential way of addressing some of these concerns, and that is to a large extent just a facade, because that's what the Americans want. They want someone to look the part and act the part front face, but also be willing to pull the necessary levers when it's necessary to do those things. And I think that's what's been lacking from the Democratic side, is that you don't have someone that can take action. You don't have someone that really pushes through on these really global difficult things like Israel, like Russia, like China, and the emergence of China, because up until Trump was there, everybody was upset with China. Everybody was. The Europeans were sick and tired of them. The Africans were, many African countries were sick and tired of China and what they did to their ecosystems and all this other things as well. And then he came in and he actually said, well, now this stops. Now we're doing something about it. Now we're introducing tariffs. Now we're drawing the line in the sand. And I think that is what America needs. If you do follow social media, I know many of your children are in these teens and going into university, that what's been coming out of America is toxic. And from a social political point of view, it's not good for future economic growth. It's not good for future demographic growth. And I think once again, you need someone that can take a hard stance on many of these issues. And I think he is the guy to do that. And not the original Trump we saw a couple of years ago, but the new Trump, I think will do a lot to put America back on a trajectory where they can offset some of the pain that we might see coming through from China as they start taking over the world more.
I agree with that, Francois. I think, not to butcher the topic, but I think that, if you look at, for example, where the US is now and why the guys are so angry at Biden. I mean, things are going quite perfectly. You got GDP growth, the stock market is at an all-time high, you got low inflation there,
Yes.
you got almost full unemployment. And then the people ask, but why is there unhappiness?
Yes.
Doesn't make sense, But if you look at the guy on the street, he still has to pay for that house and his car, and he still has to pay all of a sudden, 3% more than he used to pay a while back. So things are growing good, but they're just looking at their own pockets. They're seeing they're seeing the money go out. As for Trump, I think he's going to really play on that inflationary story. That's why I think when he comes in power, he will pull certain triggers to place America first. For example, exit Ukraine, that war. That's going to be inflationary to a large extent, push up food prices, but he won't care about that. He's going to stop immigration. He's going to be a very hard stance against us with these walls. That's also going to push up, inflation. But then there's other levers that's also inflationary, which I think he will hold back on because he is a businessman. You remember with the markets, he checked the markets all the time, and if the markets rallied, he, for example, became more aggressive with tariffs. And when the markets dropped, he pulled back. So he is an absolute businessman, and I think he understands economics.
I also think so.
So he will control it. Good, next thing. Okay, moving on. We've got, so just quickly to touch on this is going to be Francois' forte. So just a couple of things on Bitcoin. So it was actually quite ironic at the start of the year. The SEC, the Securities Exchange Commission in the US, their website got hacked. So there was an instance where everybody thought that the Bitcoin ETF was approved. It was even proclaimed on Bitcoin. Only for the guy who said it on Bitcoin the next day to return to the show and to say, but you got it all wrong. And then only to backtrack on that a few hours later when the SEC did eventually approve it. So it was quite a roller coaster ride in 24 hours. But they did approve the Bitcoin ETF. Bitcoin already last year started to react on this. The Bitcoin price went from below 20,000 to above 40,000. So it did preempt what was coming at the end of the day. Certain bulls out there do expect almost $600 billion to flow into Bitcoin. What we've seen up until date from the 11th of Jan. Similarly, when the US started to attack the Houthis, this was also approved. Was 4.7 billion of inflows into the Bitcoin. I think the reason why the price came down over the last 2 or 3 weeks was purely because of buying the rumor and selling the fact that took place. What you also are starting to see is quite a fee war. You're seeing these ETF providers, buying for funds. And it also comes amid a very difficult time to sell these type of solutions in the market because, clients argue that they can just place their money in the banks or in a bond, and receive very good returns in itself. So that's why ARK has come out. They said they're waiving fees basically for 6 months, and they're just trying to get flows. Similarly, there's been a risk that's also come to this exchange-traded funds market where we've seen leverage and also inverse crypto ETFs starting to rise. But that's natural. I think it's only opportunistic that people jump on the opportunity. But Franco, you want to add?
Yes, so I think we started once again leaning into this topic last year when the FSCA also started to allow applications to include crypto products into a traditional financial F&A risk assessment and to start providing these products and services to clients. So then we started really leaning into the research again. It's something that myself and Davy have held dear since about 2017. We spent a lot of time on this. We are also involved in some startups that are looking at bringing solutions like this to the South African and international markets. So I think we are quite familiar with the asset class. Well, we call it an asset class. It's yet to be proven an asset class if you go into the definition. But I think it's not something that we can necessarily ignore. I think it's good that we don't see the hype that we've seen in the past concerning this asset class. But it does also show that there is a form of maturity. Now, remember, something that's only it was launched in 2028, so it's now it's 15, 16 years old. So it's not a mature asset class. Yes, it's not gold. So I know they want to make it the digital gold. It's not there yet. If you talk in terms of a company, 15 years is a long time to be around. If you've been able to acquire more and more clients and the adoption is going through the roof now, it's more than 100 million people already using it, and including institutions. There was a large payment made by this Singaporean government last year. Well, I think it was $22 billion paid from Singapore to JP Morgan, received in JP Morgan in a digital currency format, the Singaporean dollar. So a lot of large institutions have already adopted it. A lot of retail use is already there, but there's not a large retail adoption of the technology. That's still coming. But if you have a business that has been running for 15 years and more people adopt it, despite the negative criticism that is clearly there. We heard what was the CEO of JP Diamond at Davos just absolutely bashing Bitcoin again. So and that's good. That's what you need for something to be tested through time. But just to ignore an asset class like this, I also think is not necessarily wise. Being kind of proven now, it's being adopted by the largest securities exchange in the world, probably the most important securities exchange in the world as well. So you'll probably see more of this. Even before that, you already had spot ETFs in Australia and Canada, as an example. It's only the US have now also approved the adoption of this asset class in the traditional financial space as well. Now, what we expect, you can't say. You can't say it's going to go up another 600, 10x. So they speak in X's, so another 10x is another 1,000%. You can't say that. Is it something that I think clients should start understanding? Yes, we've said that since 2017 when we started really getting into this. You should understand the technology. Your clients should understand what Bitcoin is about. And if they want to start introducing it, I would wait, as I said, always for FSCA approval. It's not something that we're buying in our global model portfolio or our global wealth optimizer yet. It's just not there yet. I think for someone in a balanced portfolio, even for a high net worth individual, I know many of our clients are already playing around, and I think that's very good, but you can't ignore the technology. As adoption increases, utilization increases, the price should increase. That's how you measure the value of a cryptocurrency, is utilization. Is it being adopted? Is it being used? Is there a demand for it? Because remember, there is limited supply specifically for Bitcoin. So if utilization increases, if there are use cases for it, it does increase. There are real life use cases. VET is one of the tokens, VET, VET. VET token, you can go and read how that is already being used in many of the Asian countries as a transparent way of monitoring shipments in Asian countries from Asia to the rest of the world. It's already been adopted there. It's a very good token. And there are other use cases as well where tokens are already being used by the general population as well. Just not to the extent where you have 1 billion users like a Facebook or Instagram or a WhatsApp. And until you're not really there, I think you can still see some real price alleviation, some real price appreciation for that matter. So we'll continue to monitor it. I would advise your clients just to if they are wealthy clients, our private clients type of clients, to start playing around with it. They can start including it into their portfolios. Some of the personal relationships that I have with some of these clients, we have included it in their, they have included it in their portfolios as an alternative asset class, but then really warn them against a large adoption of this technology. I wouldn't look at something more than 2.5% in terms of net assets. It's really something that you...
Yeah, I also think if you know, and also if you want to play in the space and you want to dabble, you know, also there are credible large institutions that are also coming to the front.
Yes.
Of BlackRock, for example. Vanguard said they don't want to get involved, so not yet. Yeah, until it becomes profitable, then they come running. But there are iShares products, you know, which is backed by credible institutions.
Exactly.
I agree on the 2.5% position. Just on China, so yeah, we've gotten a lot of questions, obviously, over the last 2 years on China. Post-lockdown, I mean, analysts, economists, every investor expected the Chinese economy to boom. Obviously, for consumption predominantly to rebound because people sat at home, so they didn't spend a lot of money. So to date, I mean, Chinese citizens is still sitting on $19 trillion of savings, which is a lot of money. But it's predominantly tied up, you know, in their bank accounts. We know China has basically been in this rut, you know, over the last several months. There's a couple of things that contributed to it. We see structural problems taking place in China. We see population growth has now for 2 consecutive years declined, which necessarily isn't a good thing. You know, you thought post the one-child policy reopening in 2015 that we'll start having kids again, but unfortunately that was not the case. Simultaneously, China is struggling with disinflation at the moment. So people are starting to draw the comparisons of aging population together with disinflation with what happened in Japan. But I have to say things are quite different. I think you still have that middle income class that is growing in China. That's always why when we try to approach emerging markets, you try to play the consumption part. I mean, the estimates are for that middle income class to grow to almost 5.6 billion people, by 2025. Most of those people are in emerging markets, where they want to spend, on Western products. That's why also in our portfolios, we have very little direct exposure to China, but a lot of the companies that we invest in, whether it be Nike, Estée Lauder, they've got indirect revenue exposure to China. In certain instances, more than 20%. So in our portfolio as a whole, we don't judge it where the company is based or listed. It's more where they generate revenues. And that number is around about 20% throughout our whole portfolio, which we're very comfortable with. What we've seen as of late is that Beijing has started to make a lot of noises. They've started to stimulate the economy in quite big ways. Previously, last year, actually towards the end, they placed draft regulation on their website, which basically placed gaming companies under additional scrutiny. We saw a massive sell-off in Tencent, which basically spilled over into Naspers and Prosus locally. But they have since removed that from the website. I think they're becoming a lot more pro-business at the moment. They're becoming a lot more open. So their dealings with Western nations, you can see that they're much more willing to have open dialogue than they used to. Simultaneously, the RRR rate is going to be lowered in Feb by 0.5. What that just means is that the property sector, where about 70% of household wealth is tied up in demand. It should spur demand. Whether it will is another question. Whether they're going to have to lower rates further, we will have to see. But that property sector is a crucial sector for Chinese citizens, for sentiment to return to China. So everybody's just looking at the property sector, like we've been saying for the last year. And then the final measure is that China wants to tap their foreign state-owned accounts and buy up stock essentially in Hong Kong in the region of $280 billion US. Now, why this is important? Because the Hong Kong Stock Exchange is actually $31 trillion big. So this is less than 1% of stock that they're going to be able to buy, but it's much more just a means of sentiment, what's happening there. Growth last year was quite strong in China. They came above that 5% growth target. This year, they will probably dip just below that 5% growth target, but growth is still decent, within the economy. We just need foreign investing to return back into China.
Yeah, just my quick thoughts on China. I think if you look at them from just an outside perspective over time, they're desperately trying to move into a developed market type of economy. I think they're positioning themselves globally as almost like a peacekeeper. They're very, very much challenging the US at that front, geopolitically, aligning themselves a lot with obviously the BRICS nations. And I think the West has kind of been very much asleep at the wheel while China has been evolving into that position. I think Trump was the first guy to actually start realizing it or bringing it to everyone's attention. And then, just only from them internally, I think they do obviously the issues that they face is, I think the biggest one is deflation. I think that's a terrible thing for any economy to experience. I think Francois can add there if he wants to, but I think that's much worse than higher inflation because that's just almost a downward spiral. If your economy starts going into a deflationary deflation cycle. But I mean, if you're a communist government, basically the worst thing you can almost have is a population that's unhappy.
Yes.
So their approach post-COVID has been much more measured than the US. The US have been cowboys. They've stimulated the economy way too much during the COVID pandemic, and then they had to increase interest rates at the fastest rate it's ever had to because they've been cowboys at the wheel. No one knows what they're doing, essentially.
Yes.
And so I think their approach has been much more measured. That's why it's taking a little bit longer. But at least the citizens aren't feeling the pinch of that inflationary spike. I think the inflation didn't really reach 2.5% throughout the whole period where everyone was worried about inflation, so they didn't have to kind of be very volatile with their interest rates, and now they're starting to gradually support the economy, which I think is not necessarily a bad thing, but deflation, that's something that they'll have to nip in the bud very quickly.
Certainly.
My concern is that the reason we spend so much time on China, and you even spoke to the Chinese authority on the economy, on the market, on understanding the people, the belief system, is that I can't see the shift towards EM, the search for yield happen without China coming online. Do I understand that correctly?
Yeah.
So, but the problem is that why aren't they getting this right now? Is their economy just too mature to continue growing like we know China can? Or what's the problem? Because we know that there is a shift coming back towards emerging markets. We aren't making large asset allocation changes yet from a DM to an EM from a revenue perspective. I understand that, but it must happen, let's say, in the next 10 years. We're at 2024 now. That commodity super cycle is expected for late 2030. So the shift kind of should start happening in the next 5 to 10 years, but it's not happening yet because I think China they're not coming to the table. Why?
I think a big part of it is to do with there's been a definite split between the world. It's been desynchronized economies.
Yes.
So the West has kind of got their economic cycle, and the Chinese have got their economic cycle. And I don't think that will link up again very soon. I think the emerging markets have made it quite clear with the additions to the new BRICS nations that they want to look after themselves almost. The West has definitely shunned them, especially China, with tariffs and whatnot. And I think you'll continue to see desynchronized economic growth, with the emerging markets being possibly less reliant on developed markets for growth, and more looking inward within the BRICS nations or emerging market nations for growth. So it will definitely look a little bit different than I think it has in previous emerging market cycles.
I believe that also is a symptom of deglobalization that's taking place. You will have more fragmented markets, more new supply chains that are formed over time, and people basically, bringing all the production back home. To a certain extent, it will not benefit China as much as the likes of India, and for example, Southeast Asia,
yes,
that matter. But I think you also remember investors are capitalists to a large extent, so they are hungry for yield and they're hungry for returns. So basically, what will also happen is that they will become hungry for yield again when developed markets start to struggle again.
Yes.
Just that developed markets have been so attractive, over the last several years, that why should you take the risk in China? And we've been of the same opinion,
Yes.
To a large extent. I mean, basically what will lift Chinese markets is not necessarily Chinese citizens going into the stock market, because only 5%,
I heard that.
Sits in the stock market.
Believe that.
But, if you look at, global money flowing in, you can see trillions
Going into China.
Yeah, definitely.
And that whole idea, because I like what you're saying in terms of the supply chains shifting. So it's kind of from offshoring to nearshoring. US moving some of the supply chains a little closer to home. China also moving. They've always been in that region, if not producing it in China, then around China. Is there still an uptake for something like that Belt and Road Initiative of theirs? Is that something they're going to drive to try and get those votes, that support for China, and then grow through that? Is that realistic for them?
It slowed, right?
Very much.
The last few years.
Yes.
I think a big reason for that was, first of all, COVID. It really threw a spanner in the works. But I think it's also their fiscal position that China finds themselves in. I don't think they're just going to stop that initiative.
Good point.
But they're going to partner more, and for that, they need to be more open-minded policy, because a lot of the countries with which they partner are actually developed.
Yes, it's a good point.
It's a funny thing, So I don't think that you will ever see China just becoming an isolated country and only focusing on emerging markets. There's always the developed market.
You need them, yeah.
Yeah. Happiness. The next one is just starting to move along swiftly. We just see the American markets have been on an absolute tear. If you look at, first sight at the US markets, you will deem it to be expensive. Price earnings multiple on the S&P 500 at the moment is close to 23, 24, about 30% above historic averages. That just basically tells you it's expensive. Since 2006, this is basically a graph that just shows the expensiveness of the US compared to global markets, more specifically Europe. Europe is a big component of the world index, but you can see it's almost 8 times more expensive than it was in 2006. Now, if you look at the S&P 500 and you take the equally weighted S&P, the price earnings multiple is closer to 16, 17, which is smack bang in line with its historic average. So it's almost trading at cheap to fair value, the rest of the market. So there's a lot of opportunities outside, the stocks that have really rallied. And just to explain why this has happened, more specifically last year, the S&P had a bumper year last year, climbing by more than 20%. Big reason for that is in 2022, you already had supply disinflation starting to take place, because of the supply chain issues of the pandemic subsiding. Then in 2023, a year after the first rate hike, we started to see demand disinflation. And those two have continued up until this point in time. More recently, we've seen a lot of weakness also in the property sector, in shelter. And shelter is about 40% of core inflation in the US. It's 18% of PCE, the Fed's preferred measure. So it's a massive part. And we're starting to see the effect of rates really influencing that. Now, that being said, this disinflation scenario has also created the rhetoric that federal or the central banks will reduce interest rates going forward. So, going into this year, there's about 6 rate cuts that are priced into the bond market at the moment, but we don't think they're going to cut 6 times. Even if they cut 3 or 4 times, it's still a good thing for the market. If you think about it, that together with a strong labor market and inflation that is already low is going to boost the consumer. That's why we think, the market, even though things look as if it's starting to go difficult because interest rates keep at this level for a very long period of time, we actually think that it's still conducive for markets, the environment that we are in, and that's good, for you as a global investor at the end of the day. I think do anyone want to add?
No, that's good.
Renier, I think just to comment on that, we're in an extremely sort of strange position now. We had more or less the same after the global financial crisis, that it's now good news is bad news and bad news is good news, and no one really knows what's going on. So if it's better than expected employment, better than expected spending, GDP, then people are concerned that rates might take longer to come down. But on the other hand, if the data is weaker, then they expect rates to come down quicker. But data that's weaker is weaker. So you can't necessarily say that's good. So I think the position is that rates will come down. The question is, why will it come down?
Yes.
Will they be allowed to bring rates down because of easing inflation? Or will they be forced into aggressive cutting because of a struggling economy? And I think, actually, if 6 is priced in, I think that's sort of an ideal scenario. With some of the earnings, you can elaborate on that, some of the big tech names. I think if they cut less, let's say 3 or 4 times, while being afforded to cut with a falling inflation within acceptable range inflation, that's actually much better. If they cut 6 times, it's probably because they are sort of desperate to cut, and then it means they've overdone it with rates and they're now desperate to try and save the economy. If there's a more gradual cut, then it's probably because of the resilience of the economy. And I think that sweet spot, if they can find that sweet spot where you can cut, you are allowed to cut, but you're not forced to cut. And even if it takes a bit longer, you still have that resilient underpin of the economy. I mean, that can actually then work out very, very well and sort of get a soft landing. One need the markets to deflate a little bit, but as you've shown, or probably will show, is that, that magnificent 7 stocks, and not in necessarily 7, but the top 10 or 20 or some of the biggest stocks contribute a big way of that PE that's, let's say 7, 8 above its average. So I think, yeah, the eyes should be on why they are cutting, not necessarily on how much. And I think a less desperate downward trajectory can be much better than actually a desperate quick fall rate.
That summed up perfectly. I think from a portfolio point of view, you almost have to be positioned for both scenarios. So what we've done in our portfolios more specifically is that we've held quite a bit of cash, for a while, but there's always been dry powder that we can utilize in markets. And if we see prices trading at the levels at which we see, and we want to own those companies for 3-5 years, but irrespective of what's happening in the markets and whatnot, I'll talk about that a little bit later on. But we buy the stocks. So it just happened that we own quite a bit of cash, at the current moment, but I don't think it's a bad time to be owning cash for exactly what Etienne is saying now. You can see quite some bouts of volatility because of reasons why, market participants do what they do at the end of the day.
Are we going to, can we speak about it now that some of that reports that's saying that the S&P is coming down this year, or do you want to speak about it later?
We can talk about it on the next slide.
Okay, cool.
So if you just look at the Magnificent Seven, as Etienne has alluded to, thinking ahead. So what he's alluded to is basically the Magnificent Seven carries a major, weight in the index. So to such an extent that it's basically 70 or 30%, of the S&P 500. So it's only natural that multiple trades are at 23 and the rest of the market is at 16. But it's gotten a little bit out of control. I have to say, if you look at the market cap of this Magnificent Seven, they're now the same size as the Japanese, Canadian, UK stock markets combined. Another way to see it, it's a bigger size than the GDP of every country in the world except for China and the US. It's becoming incredibly big. It's almost a case average down the stock market when one guy says now he has this idea that can excel and somebody hears sell and they all scream sell, and it's a frenzy of everybody selling. And on the opposite, this guy then gets irritated and he leaves and he says goodbye. And when he says goodbye, there's one oak that's years by and everybody buys again. It's almost a self-fulfilling prophecy in the market. So we know that a lot of these companies, all 7 of them, have tangible underlying products that are doing quite well. But what we look at is more what's the growth like in comparison to where the companies trade at the moment. So for that, we look at the price earnings growth ratios of each of these companies. Peter Lynch dubbed this ratio. So it looks at the valuation. How does the future growth look? Any number above 2 is incredibly expensive. Any number below 1 is quite attractive. Anything in the middle, you can basically do with it what you want. So on the left-hand side, I've just, beworded some of the problems that these companies are facing whilst they have these incredibly high valuations. Apple at a 2.7, they're facing a slowdown in devices coming under competition from the likes of Huawei. In China, simultaneously, there's increased regulation in the app stores. Microsoft, we hold in the portfolio. There's no real concern in Microsoft's business model. So we basically don't exit the stock just for the sake of exiting a lot of the times, except if the valuation is so expensive that we just don't see any growth over the next few years. But even at a 2.6, that's not the case with Microsoft. So we're holding on to that company. Tesla dropped by 12%, yesterday, after guiding softer, that they're going to deliver fewer vehicles because of demand slowing down. They're facing increased competition from, Chinese electric vehicle manufacturers that are using lithium phosphate batteries in the car and producing the car at half the price as Tesla is manufacturing it. Meta is facing additional capex expenditures in the metaverse, but simultaneously they're vying for competition on social platforms with TikTok. Google, we own. Google is not, you can see it's not incredibly expensive. It's still a monopoly in search. It hasn't come under pressure from ChatGPT and Bing. We quite like that. Amazon, same story. They're still dominating the e-commerce market in the US, even with incoming threats of Temu and the likes of Shein. But the big story, the dark horse in the market is NVIDIA. So NVIDIA at a 0.9, very attractive. Problem just is that the market is pricing NVIDIA as a monopoly for the next decade. That very rarely happens in the technology space, where basically a company overnight, you can start competing with another company. We've seen Google and Amazon also manufacturing their own chips. 5 years out, perhaps they have a chip, that competes directly with NVIDIA, and then this whole story rewrites. So not that we're saying it's not a good asset to hold. NVIDIA has other quality as well that we like. We just aren't willing to stomach, the multiples of paying that for a company. Pull that through to the S&P 500 and an index more specifically. I've mentioned these companies comprise 30% of that index. That being said, given that a lot of these companies are expensive, it almost puts a cap, on the upside for the S&P if the rest of the market don't perform. Now, these companies are just so big in that space. I think what's more important is that you have an active stock picking strategy where you can go in the rest of the market, go and extract value. And we'll explain shortly what we've done. You guys want to add on that before we move on?
I think that the most important thing that you always have to remember is not to do anything at extremes. And Etienne always a big proponent of saying that. So when you're taking, money offshore and you have to think about the currency, don't do it at extremes. Same thing with markets and stocks. I mean, when stocks are at extreme valuations, you have to be very careful entering them at that point in time. And it's the same thing with if a stock is falling. I mean, if it's falling, it's falling for a reason. You have to be very careful when things are at extreme levels. And I think we are at that point in time with those Magnificent Seven stocks. So one has to be very careful moving around them. And I think, that's one thing we try and implement as best we can, not to make moves on it at extreme levels.
I tend to agree with that, Christian. If you look at research as well, when a company downgrades earnings and you see a drop of more than 10% in the share price, it's actually quite funny. Usually a couple of months later, they downgrade earnings again and you see a similar, if not more, decline in the share price. That's what happened with Fortinet, actually, quite ironically. So a lot of these companies, I think, that are starting to come under pressure now, it's not the end. It's not the end for them. And the end market is also not becoming more attractive, which is kind of the funny thing. On the downside, we quite like excesses because that's where we make a lot of money for our clients. For example, if you have a crash, I mean, that's an excess. That's usually when we like to pick up our highest quality stocks because then you double your money a lot of the times overnight. But in these type of markets, falling catching knives, you have to be very certain that you're not buying a value trap. And that is why with China as well, trading close to all-time lows, there's reasons for that. There's opportunities, but you have to be very certain that you're not buying a value trap.
Yeah, I think, Neil, on that point, I mean, there's a massive difference between acknowledging that you can't time markets perfectly and not trying to attach any sort of value to valuation. Valuation is still very, very important.
It is.
If you buy a good quality company, and I think you later on you'll go a bit deeper into quality investing or the start. Good quality companies tend to outperform over time, and your entry level doesn't have to be absolutely perfect. Same with the currency. The rand tend to weaken over time, so your entry level doesn't have to be perfect. But at certain extremes, it sets you back a couple of 2, 3, 4 years before you start making a return, and then your annualized return suffers forever on that. I mean, if you look on the currency from 2015 to basically 2020, it appreciated, and it was just an extreme. It took 5 years to come back there.
Yes.
And it might be the same if you buy the wrong companies now or the right companies at the wrong prices.
Yes.
It can be the right company, the right quality. It might still be in existence in 30 years' time, outperform relatively over its peers or the market.
Yes.
But you just need to avoid extremes. You just need to, in a fair value range. You'll never find the exact perfect spot, but within a fair value range, that's fine.
Yeah. So I've got a very nice graph on that. I'll show you shortly, which sums up exactly what Etienne has just said. The analogy, and I think it also ties nicely to this discussion that we're having at the moment. If you look at the analogy of the Tour de France, so We know we've got a lot of cyclists on the group. In between 150 people, there must be at least, 50 cyclists. Everybody's cycles nowadays. So the Tour de France is basically just a 3-week stage race. They cover 3,500 kilometers. Very attractive in terms of watching it on the TV, the landscapes, the scenery. It's usually in August. What strikes me about the Tour de France, and if you compare it to markets, is that, there's usually the peloton, and out of the peloton, there's usually one rider that breaks away and they win the stage. But very rarely do that one rider win every single stage of the Tour de France.
Yeah.
What matters more at the end of the day is, in different stages, you climb, other stages are flat. What matters at the end of the day is that, you need to be incredibly good at one discipline and not bad at the other disciplines, in order to come out at the top and to gain that financial success and to win the yellow jersey at the end of the day. For example, with the mountains, when the terrain is difficult, and things really don't go as planned, those are when the defensive funds outperform. In the flat stages is usually where high frequency traders have the edge that use the derivatives and leverage. It's almost akin to steroid usage in the Tour de France, so we don't base ourselves from quarter to quarter or year to year as these stage winners. We rather try to be the best at a certain discipline and not be bad at others. And over time, that accumulates to very good performance for our clients. That's why we are quite longer term investors. Now, this starts to tie to Etienne's point. If you just look at styles, quality over a 25-year period, it's outperformed most styles. It's even outperformed the MSCI World Index. That is why we consider ourselves quality investors. And what are those companies? It's exactly like Etienne said. You can buy a stock like L'Oreal, that anything that goes on people's faces or that they put in their mouths and in their body, people aren't that price sensitive. They'll rather pay up if it goes on their face or in their body. L'Oreal is exactly that. Now, if you bought the stock in 1973, quite ironically, you would have, at these multiples, at 281, it's absurd. I mean, nobody will go and buy the stock at 281. You would have still beaten the markets over a 46-year period. Quite funnily enough, you would have received 7%, where the markets did 6.3%. If you bought a stock like Brown-Forman at 174 multiple, would have still gotten your 7%, beaten the market. All these stocks, you can go through them. Coca-Cola at 63 is an absurd price to pay. Now, it just basically goes to show how these companies grow into their earnings and how they're never really cheap, as Etienne has alluded to a large extent. But that being said, we are price sensitive and we aren't willing to overpay. For any company, you can make mistakes.
I see even BATS is on that list, René.
Even in all three.
I saw that.
I considered hiding
historically. But I think, can I just mention on this point, because we're going to touch on it later, but this is really that idea coming through of being a long-term investor. Mm-hmm. And I won't go into it now, but this is just really highlighting that you can buy something like BATS historically, or a good quality company, maybe not like BATS, but like L'Oreal that we've had in the portfolios, and it should create a lot of value in the long term.
Yes, exactly. So these companies usually grow into those things. That's why we seldomly don't just want to exit the stock for the sake of exiting, because we know over a long period of time that you can be proven wrong, but you need, as Francois said, time in the markets for it to pay off.
Yes.
Similar to what we always see as well is clients switch out of strategies just at the wrong time. They will look 1 year to the next and then see this thing outperform, similar to a stage in the Tour de France. They will switch, incurring fees and taxes, only to see that the strategy which they shifted out of outperforms in the next period, due to economics turning around or whatever the case is. And that is the biggest source of our value destruction that we've seen clients can basically make in the portfolios. In between 2000 and 2018, there was a fund, GMS, that did about 18%. The average client in that fund at minus 11%. Big reason for that is because everybody bought in 2006 at the top of the market, but they climbed out in 2008 at the bottom of the market. So it shows you how value can be destroyed. Moving on swiftly, those companies that we've spoken about now, these quality companies, these are the sectors, usually consumer discretionary, consumer staples, healthcare, information technology. You can just see, how earnings have grown over time. Other sectors like financial, utilities, communication services, materials, energy, usually we either try to trade those sectors or we pretty underweight in those sectors. You can see earnings just moving sideways over time and creating a lot of volatility in the portfolio. What's in, what's out? ASML, we've spoken about it in the past. It's a semiconductor company. All the chips that goes into our phones and computers, everything that's smaller than 7 nanometers, they need machines to make them. ASML is a monopoly in that space. There's no other machine that makes them. Those machines go for between 200 million and 300 million a machine. Quite an incredible feat. The revenue numbers speak for itself. You can see how it's just consistently growing. Next one, Couche-Tard, Alimentation Couche-Tard that we bought into the portfolio. It's they have convenience store and gas stations. What we like about this company, look at the performance graph on your left-hand side. It's been the most consistent performer on the Canadian Stock Exchange over the last decade and a half. We know interest rates were low, but Couche-Tard also did things right. They did these smaller bolt-on acquisitions that we really like. Simultaneously, it's a recession-proof because people have to fill their tanks during a recession. They have to go buy bread and milk, from the convenience store. As of late, Couche-Tard has brought in fresh produce. And then, as I've mentioned, as I've not mentioned, the electric vehicle shift now. They're one of the leaders in terms of implementing these electric charging stations at some of their gas stations. And what that translates to is that people just spend more time at the gas station, they buy more products, which is good for us. Last one I'm just going to touch on is Berkshire Hathaway. I think this needs an introduction due to Warren Buffett. What we like about this company is that its equity portfolio is more than half its market cap. It has 350 billion in equity. More than half of that is Apple shares. Apple last year did extremely well, but you haven't seen the same reaction in Berkshire's share price. They're sitting on an immense amount of cash, which is invested in US treasuries, where they're earning more than 5% yield. And lastly, they're using this cash to buy back stock. So over the last 12 quarters, they've bought back almost 10% of their own company. You can see it on the right-hand chart. What did we exit? Costco. It's one of these higher quality companies that I've spoken about. The thing just with Costco is we didn't foresee any growth in the stock over the next 3-5 years. It didn't warrant for us to hold on to it. You can see that just in terms of what happened, to its valuation, it's trading at all-time highs, despite interest rates being high. So we just shifted out of Costco into another high-quality company, Alimentation Couche-Tard. We exited Alstom. Big reason is contracts that didn't go as planned in 2021, but we, however, found out more recently as well that they've got inventory issues, they've got low orders going forward. It's just a myriad of problems. They're going to have to do an equity rise. The share price declined, but you're sitting in a value trap. There's just no value out of Alstom. We exited it. Same with Ping An. They're playing into the secular market that makes sense. People need insurance in China, but less than 10% of the population are actually insured, funnily enough, in terms of medical aids, etc. The problem with Ping An more recently, sentiment. Beijing has made sounds that they're going to have to take over or merge with Country Garden, take over all of that debt. And very rarely we've seen companies taking on that amount of debt and recovering out of it. So Ping An, we've rather switched into Berkshire, where we're already in the money. We're doing quite well. Then simultaneously, we've started taking legs in Pepsi, for example, Fortinet, the cybersecurity company. So there's ample opportunities that we are seeing in the markets at the moment. But we are active, as I've mentioned, from the start of the year, more than 7 trades that we've done into big companies. I think this is where we are starting to hand over a little bit more to Francois, just on the financial game plan. Everything that we've now said, basically just taking it into context and translating it. How can it be used, for your client at the end of the day? So Francois, over to you.
Yes, so I'm glad to see that we still have so many people online, because I think the next section will be very important. We've been spending really a tremendous amount of time over the last couple of weeks to get to a place where we can help the clients through this next year. And I think not just the next year, because it's a very short-term horizon, but I think over the next, let's say, 5 to 10 years, in terms specifically about asset allocation in their holistic view, in terms of how they view asset classes, including how the currency plays into that. So I think we'll start just maybe with the currency. So if you are still here, I'm very glad, because I think you're going to find the next couple of minutes really informative, and I think it will really really help you with some client conversations going forward, especially on the asset allocation if you speak to them about that. So the currency, I think what we try to hone down on here is to get to a point where in the long term, we need money offshore. So if that is your view, if you understand that in the long term, we want to take money offshore, then the currency, well, is an important factor. But I think in the long term, the rand depreciates. That's it. That's the bottom line. That in the long term, the rand depreciates. Now, there are bouts, like Etienne said, where the rand can appreciate, get stronger over a 5-year period. So that's why when we speak about long term, in the past, when business cycles were short, the long term was 4 to 6 years. So you would tell a client in the next 5 years, we want to give you returns of X%. Now that business cycle has been extended, we spent a lot of time in the past explaining why. And later, if there are questions, we can go into a bit more detail, but let's just leave it there. So business cycles are not 4 to 6 years anymore. They're now 5 to 7 years, at least. So it can happen that the rand appreciates for the next 5 years. That can happen. Will it appreciate back to levels of 16? Really doubt it. Will it appreciate back to levels of 17? Might see a 17 if everything really works out well with the elections, which we're not really putting our necks on the block for. So you'll probably see in our, well, let's call it a base case with the highest probability that the rand remains around these levels for the next 5 years. Let's call it 18 rand, maybe 19 rand. Now, once again, what does that mean for taking money offshore? Well, and on the next slide, we'll go, we don't have to go over yet, but then we'll touch on that in a little bit more detail. But when you do consider the currency, the rand, and make that part of your asset allocation decisions, I think the rule is in the long term, the rand must depreciate. Not because we are so bad, which we sometimes are, not we, I mean, our government and the policy that they put in place that puts a lot of sentimental pressure on something like the currency and even our markets. It's because of inflation differentials. Now, historically, our inflation is higher than someone like the Europeans or the Americans. And for that reason, buying power deteriorates faster. And for that reason, the rand should depreciate in the long term. So that should be your starting point when you speak to a client. It's to say that in the long term, the rand depreciates. That does not mean that in the next 5 years, the rand can appreciate and remain around these levels. So if you now take money out at 19, and in the next 5 years, the rand is back at 18, you did not destroy value. If you give it 2-3 more years, the rand will probably be at 22 rand. And then over a 7-year period, you still unlock 3 to 4% on the rand alone, which I think is really just laying the foundation for the conversation.
But I think also, Francois, that comes to his point as well about extremes.
Yes.
If you saw what we saw when Nene was fired in end of 2015, the rand depreciated by 30% in a month or two.
Yes.
Then your chances of having a 5-year period of continued strength is much higher. If it's close to that fair value range, fair value band, which we say now is, let's say, around 18, so between 17 and 19, it becomes a much more sort of favorable to do that. Even now at 19, we might say it's at the less favorable side of the band.
Yes.
But it's still between 17 and 19. So chances of 5-6 years of continuous strength is much lower. But if we saw a short-term week just before COVID as well, you saw it spike out 25% within a matter of months. Then it is in the long term, if the long-term trend is between 3 and 5% weaker, then if you see a quick 20 or 30%, chances are that it will come closer to mean revert. So that's just the thing. I think just make sure it's within acceptable bands. And I think if nothing out of the ordinary has happened over the past 3 or 6 months and you haven't seen that big spike, then you can do that. I think we'll elaborate on that now as well. It also depends on what type of money. So whether it's sort of a basic need that you have to have it there, or whether it's speculative and you're trying to time the market a bit more because you want to make short-term money or whether it's part of your bigger financial plan, holistic plan.
Yes. I'll just say one more thing on the rand, and that's that we aren't changing our long-term value that we've been able to add to clients. In the past, we would say, like last year, if the rand strengthens, appreciates back to 1750, trade there, or 18, and we were waiting for 18. What we've now seen is, and what we are growing concerned about, is there are so many moving variables now, with the 2/3 of the world going to elections, the S&P being overvalued, the questions about interest rates and when they will be hiked, lowered, and to which extent. And so there are so many moving parts that we would err on the side of caution. And that's why Etienne keeps on getting back to this point. Avoid the extremes. So don't trade when the rand bombs out to 22 if something happens wrong with the elections. That's not a good place to buy the rand. Can it go to 30? Well, maybe not. There's a 5% chance that it can maybe go to 30, but we'll most likely not see that unless everything is really, but then we'll have ample enough time to make it ready for that. So avoid the extremes. We're not changing our long-term stance on when we would like to trade, but because of all the uncertainty, we've had to change what we do with capital allocation this year in 2024, because you can't just sit on the fence. And that's what I'll touch on now. Aubrey, before we go on, do you want to ask a question? I think we can.
Pranjal, I just wanted to ask if I can maybe into the chat section pop the that graph that I put in the other day when we had the separate market call planning discussion, because what was very interesting for me, and I mean, obviously you're quite right in saying that the interest rate differentials over time and inflation differentials is obviously what has led to the rand obviously deteriorating over the last 2 or 3 decades against the dollar. But you know, what was interesting for me from that graph that I put up, which is the rand dollar level versus the purchasing power parity level, is, you know, like in many technical analysis, the trend is your friend. It's almost as if from the mid-80s, it's just the purchasing power parity just has not actually started coming down, which means that from a local production perspective, our production has never actually been at the levels that it's been prior to, let's say, the mid-80s. The graph didn't go further back than that, but I mean, we all know that there was a stage, you know, in the 60s or 70s where the rand was actually stronger than the dollar. So yeah, maybe just put up that graph, and maybe that'll also lead advisors and clients to say, look, even you know, some of the bigger investment companies that we've regularly talked about regarding the rand was saying, you know, 5-6 years they can't see the rand not depreciating further, but the graph will also clearly illustrate where there is big deviations of the rand dollar versus the purchasing power parity level. And like you say, I mean, it's those extremes where the disparity is big, where one has to be cautious, but the general expectation, if you see the trend, can always be that it's going to deteriorate over time, unless there's a drastic change in South African production and, you know, we become a very capitalistic country overnight.
Yes, which we're not necessarily expecting. So I agree, and we appreciate that long-term graph, and that's usually something that myself and Davy base our analysis as well, is to look at the long-term purchasing power parity, and not just the Big Mac index, but a basket of goods and services to see, is the rand truly undervalued or not? And then there is this long-term about it's 55% undervalued. And what we've seen over the last year is that we have moved above that. So that means the rand can be appreciative. The rand can get stronger. And that really brings us to what I'll briefly just touch on in terms of the elections locally, is that it seems to be that we are facing these two broad alternatives, or two alternatives that seem to be quite far away from one another. The one is the ANC losing by a large amount that would force them into going into a coalition in one of the important provinces like Gauteng, Natal, or Western Cape. And important, the rest are not important. I mean, from a contribution towards GDP in South Africa to where the money bag is of South Africa, where the revenue is generated for government. If they are forced to go into a coalition with the EFF in one of these provinces, which will most likely be Gauteng, then it will probably have a negative impact on sentiment, which could weigh on the rand and potentially the markets, the local capital markets. That being said, you can't really put a rand amount to that. Will we see the rand spiral out to 30 rand then? I doubt it. I still really doubt it. Can it go to 22 rand or 21 rand? Maybe. But really at these levels of 19 plus rand, the rand is so overvalued that it'll be a short-term blip and then a stabilization as people start realizing, well, a lot of the bad news is already priced into our capital markets, including the currency market. Then there's the case that you can actually see the ANC not losing by too much, so that they can go into coalition with some of the smaller parties, Action SA as an example, the African Christian Democratic Party, which has quite more market-leaning policies, and then that can actually alleviate some of the pressure that's been wound up in our markets and in our currency. And then you might see the rand, well, go see 1850 or 18 rand again. I don't see us going back to 16, 17.
Well,
yeah?
I think, I mean, if you look objectively, if you forget about the elections and
Yes.
possible shocks, that the base case is that a dollar should weaken
Yes.
and the rand is undervalued, or
Yes.
too much bad stuff has been priced in. So I think the rand started here at 1827. From there, we can strengthen by between 5 and 10%.
Yes.
So we can move back to 70. Probably 16, 15, probably unlikely. 17, definitely a possibility.
Possibilities.
If you have discretionary funds, speculative funds that you don't have to take out,
Yes.
and you want to try and time the market, and you look at that and you are willing to take the risk that there's not going to be any shock to the system,
Mhm.
you should wait for the rand to appreciate.
Yes.
Only issue is there's a lot of uncertainties. That
Yeah.
can be a quick shock and a quick move towards the downside. That can be 10, 20, even 30%.
Yes.
I think that's become a lot, but I mean, we don't know. A shock is called a shock because you don't expect it and you don't know how severe it will be.
Yes.
Then it can be 21, 22, 23. All else equal, if you look at what's been priced in, a lot of negative has been priced in. If there's no external shocks, it should appreciate during the year.
Yes.
Yeah, not expecting it to appreciate by 20, 30%, but between 5 and 10%, definitely possible. From 1820, 10% is, well, basically 1650 at sort of a best case, but I mean, 1750, 17 definitely what you should be looking at if the election and everything
Goes as according to plan.
goes well.
Yeah.
I also just have to say the opposite is also true. If you see a spike out in the rand and it appreciates by quite a lot, clients mustn't feel necessarily the urge to bring money back necessarily. They can, for example, if they have a large component of funds offshore, they can actually speculate on perhaps a portion of that, bring that back, basically take advantage of a rand that then appreciates to a certain extent. But I very rarely do the rand spike out. Global markets basically also pull back while the rand is appreciating, and then they get the opportunity to take money out again and re-enter the market. That never happened. I've never seen it in my career.
It's almost like selling Microsoft or something, like you alluded to. If it's a quality company that you want to own for 10 years, it might be slightly overvalued in the short term, and there might be a 10% pullback, but to time that perfectly to get out and back in, if it's actually something you want to own in the long run. And I think in this case, so again, I think if you have a need or you plan to use rand sometime, yeah, then if it's an attractive level, bring it back. If you need foreign currency, then take it out. Don't try and time it perfectly. If you have too little foreign investments and your overall planning tells you to take more funds offshore,
Yes.
it's not extreme. Take it out because what if there's a big shock?
Yes.
If it's purely dividends, profits from your own firm, and you want to speculate a bit, then there's a case to wait for better levels. But the thing's just, if it has to be out and it isn't out, then it's a very big risk you take just to hang on.
Agreed. But what I think we have come to a rather big conclusion, and that's the type of client that you work with. So, and I think that's the important part, is what does this mean now for an advisor or for a client that might be listening, is that you have to determine, is this client a balanced fund client, a month-to-month client, a client that opens his statement every week, every month, and wants answers from you. I would be cautious then in terms of just at this rate, just taking money offshore. I would be cautious about just investing in equities now for someone that's like that really doesn't understand that this is a long-term thing. They just have this balanced mindset. I want my balanced portfolio, my income I want every month, and they just don't understand the risk-reward trade-off. Then I would be cautious now. If it's someone that understands that, why do I invest offshore? And understand from a liquidity perspective, from an opportunity perspective, from a value add perspective, from a growth perspective. And I understand why I am investing offshore: to protect myself against local uncertainty, to protect myself against the long-term political uncertainty and rand depreciation in South Africa, to have these global opportunities, to build wealth in the long term. If they understand that, then the conversation becomes, yes, let's take out money, and at potentially which level. I think what we've concluded then from there is to say that if it's someone that already has funds offshore, so let's say they have a good, as research has shown, between 40 and 60% global exposure. If they have that, then they can phase into markets, and they have, so let's say they get more discretionary money, interest rates fall, and they feel a little bit better mid-year, second, third quarter, and now they want to take more money offshore. They want to increase that offshore exposure of theirs because they understand the long-term story of why we invest in global equities. Then I would say, as Etienne says, maybe wait and see if you can get a stronger rand. Maybe wait. But I would still phase in, I would say, at least 30% of that money. So let's say the client wants to take out R1 million this year, take money out now, 30%. And then we can see if we can get a better currency later. If it's someone with no or limited amounts of offshore exposure. So this is a client who has between 20 and 30% global exposure. I think this is a difficult place to be in. I don't think in the long term this is a very good place to be in if you have too little global exposure, because remember, with global exposure, we're not just speaking developed market equities. We're talking about these long-term shifts. We're talking about the rand possibly depreciating. We know about all the political uncertainty in South Africa that might increase over the next 4 or 5 years at least still. Then you are really running a large risk on your investments if you don't have enough global exposure. Then I would say take out, and the client now says, well, I have some more discretionary money. Should I invest it? Yes, then invest it. Invest up to 50% of that money global exposure. Take the risk off the table, but they have to understand, once again, this idea of what is a long-term investment and what are the benefits of that. So then just lastly, I think that should help the conversation with the clients is that why would you invest offshore? And I think that story is what we'll be reiterating. René wrote a very good article that will go out this week. Last week, we started with the newsletters again. And what we are going to start doing now is really talk a lot more about this. And in our feedback on the market polls, market call, the economic newsletters, everything that goes out, to try and re-educate in terms of long-term investments. Why do you invest in equity? Well, obviously the capital gains advantage, you're only paying 18.6 or 21.6% tax, and not the income tax rates that you get from dividends or bonds, which you're paying in excess. That just gets added to your personal income tax rate. So you're losing out on a lot. So from a tax perspective, it makes sense to invest in equity. From a long-term growth perspective, it absolutely makes sense to invest in equity. And especially on the global side, you are then also protected from this local political uncertainty, this theme that we've seen really over the last 10 years that we do believe can continue to happen and take place over the next couple of years. Renier, guys, I don't know.
I also think that there's a lot of capital in offshore markets that's sitting on the sidelines still that can come back to the markets as such when interest rates start to decline. So just keep that also in the back of your mind. As if the environment starts to slow down, as Etienne has alluded to, and you have inflation coming down and interest rates, eventually there will be a shift of capital. Then you might see another spurt.
Yes.
But at the end of the day, you want stability.
Yes.
As far as possible. Stability is quite important.
Yeah, let's maybe, we have more slides. I think we're almost through it.
Any questions?
Yes, there are any questions. I didn't see any questions in the Q&A. You can still post them. You can just go to, at the top of your tab, you'll see there pop out chat, and then, or you can't see the chat. You can just, I think, see Q&A. You can push that and then just say start discussion, and then you can just write what your discussion is if you have any questions. Specifically on, I think, the asset allocation portion, if you have questions there, please reach out to us. If you have questions about specific clients, please reach out to us because we are still able to, I think, determine on a client-specific level whether there should be a shift towards the global markets, and especially to take advantage of the currency where it is now. Dion, I hope you're still there. We had a good chat now. I want to give over to Dion. Yes, there he is. I can hear you.
Hi,
Yes,
Francois, can you see my screen?
I can. Perfect.
Good. Good morning, everyone. I'm going to provide also update from markets. Some slides might be similar to what you've seen this morning, so just bear with me. So just before we start on markets, just on performance, it's been quite a good year in markets. Our income portfolio at 10.5% for the year versus money market of 8%. So for even the low risk investors, it's been an extremely good year. 10.5% return is a very good outcome versus inflation of 5.1%. And even today, the yields are still close to 10%. So we might not be able to get the 10.5 like we did last year, but still get about 10%, which is still much better than money market. You can see all the portfolios from low equity to high equity, all the portfolios deliver double-digit returns. Flexible 14.6% because that's a more aggressive type of balance fund. And then just on the equity side, a low single-digit return of 7%. But a global equity once again 28%, a terrific year for most funds out there. Post-retirement similar, between 12 and 13% return for the year. I mean, on the global side, even a cautious portfolio in dollars delivered 9% return, and global equities to 20% in dollars. But looking forward, it's not clear what the markets will do. If you go into the slides on earnings, so why did markets recover last year? It's because earnings didn't decline last year like everyone expected. I think last year was probably the most expected recession that never happened. So everyone expected earnings to decline last year. You can see there was a small decline, but earnings at least recovered. So it just moved sideways during the last 2 years. For the last 2 years, no earnings growth. It just went sideways in the US market. And for that reason, the S&P 500 recovered last year to get back to the previous high at the end of 21. So last 2 years, no return from the US market. It just recovered to the previous high due to earnings that didn't decline by too much. But looking forward, it's unclear if those earnings will continue to recover because the excess savings the US economy had or consumers had after COVID, that has now been depleted. You can see there's the savings rate has now dropped below the 6%, which used to be the long-term average. So that if you use all that excess savings, which they had after COVID, they spend most of those savings. You can see that the green line is a long-term trend, and you can see they've spent a lot more after COVID on consumer goods. So sales went up, but during the last couple of years, that sales is just moving sideways. And that's why earnings has also moved sideways the last 2 years. So most of that additional savings that was accumulated was now spent during the last 2 to 3 years. So consumption is already starting to decline in the US economy. So we've seen this significant growth in consumption in the US market, but that is already starting to decline due to high interest rates and inflation. We're starting to see that people are struggling to pay their debt. The default rates are starting to decrease across different type of categories. So consumers are starting to struggle to pay their debt due to high interest rates. The debt to cost is not that significant yet. It did increase due to high interest rates, but it's not as near as high as it used to be in the past. So that's why many of the research providers, they expect a recession, but it will be a soft landing because they can say the consumer is quite a good position at the moment. So yes, earnings will come under pressure, but it probably won't be a severe recession because the financial or debt cost is still low compared to the long-term history. But the jobless claims are starting to rise, and it's quite a good leading indicator for consumption in the US market. So we've seen last year where jobless claims have started to increase. So it's an inverse chart. And you can see it started to increase. So that green line, which is consumption, tends to follow jobless claims. So the consumption rate in the US market might fall this year due to higher jobless claims. Maybe the one risk that BCI highlighted to the rest, so BCI expects the US market to decline by 20 to 25% this year due to earnings that might decline by 10%, plus a further derating of the US market of 10 to 15%. So in total, they expect about a 20 to 25% decline in the US market. But they say the risk to their view is that there's a lot of cash still available to consumers to cope with high interest rates and inflation, and also to invest that money into the market. You can see since for the last 10 years, there was a significant increase in deposits at banks, both on deposits and money market deposits. So there's a lot of cash sitting on the sideline waiting to be deployed, either in the market or for consumers for consumption. So there is some scope. So BCI said this is probably the biggest risk, that the soft landing or the recession might never happen because there's still a lot of cash on the balance sheets of consumers. So although the overall market is expensive, there are pockets of opportunity in global markets. We've seen the tech rally during the last 10 years. So the US technology sector is much more expensive than the rest of the market, similar to the highs it was in the IT tech bubble of the early 2000s. We can see in 22, there was a decline in the valuation gap. So the rest of the market performed well. And that was an environment with value fund managers like Allen Gray or Orbis performed very well. But last year, once again, tech outperformed the global market. And for that reason, value fund managers or active fund managers, many active fund managers underperform the market because it was mostly driven by the tech sector. Another opportunity might be emerging markets for the next 5 years. We've seen this in the 2000s where emerging markets outperformed for 10 years, including South Africa. So South Africa, other emerging markets outperformed developed markets for 10 years. But during the last decade or slightly longer, developed markets has outperformed emerging markets. We're not at the previous low it was in the 2000s, but we're getting close to that level. So if you have a 5-year view, emerging markets just might be the region to be in for the next 5 years, if you look at this long-term chart. On valuations, developed markets is generally expensive. But to illustrate in this slide, there are pockets where there's opportunity, especially in the small mid-cap space across the world. I think there was a slide earlier that showed that the rest of the market didn't perform during the last couple of years. It was mostly driven by the US market, specifically the tech sector. But there are still pockets of opportunities out there within the small and mid-cap space. China, in order for this chart of DM versus EM to reverse, for EM to outperform developed markets again, China needs to perform better. And currently we see the government is not stimulating the economy enough. It's actually contracting at the moment. So on a fiscal point of view, they're not doing enough, but on the monetary side, they did reduce the repo rate to stimulate the economy. Unfortunately, the short-term rates actually went up to protect their currency. So even on a monetary policy side, there's mixed signals. Repo rate went down, but short-term rates went up. So in general, the Chinese economy, there's a lot more they can do to stimulate that economy in the stock market, and that will be bullish for emerging markets and will assist emerging markets to reverse that trend. And this is just to illustrate that developed markets, US equities, are extremely expensive on various type of signals. Here they use the CAPE ratio. CAPE is like a PE ratio, but it's a long-term signal which tends to be more stable. So emerging markets, fair value, China cheap, US developed markets are expensive. MNG, they expect for the next 5 years that SA asset classes will perform much better than it did during the past 5 years. So on the low side, cash should deliver inflation plus 4%, and at the high side, listed property and equity inflation plus 9%. So they're extremely bullish about all asset classes, cash, bonds, property, and equity. Globally, it's at fair value. So there is some uncertainty, but it's also not expensive. Like I showed, there are pockets that are cheap in the global market, but overall, it seems to be at fair value. Currencies, the US dollar remains strong. The US dollar is about 17% overvalued versus other developed markets, and about 28% expensive versus emerging markets. And in order for emerging markets to start outperform developed markets again, for value to start outperforming quality and growth, one needs to see this reverse in the dollar strength. The dollar is extremely strong against most currencies, developed markets and emerging markets. And when this dollar starts to depreciate, that will be supportive for other developed markets and emerging market stock prices. But BCA don't expect the dollar to depreciate this year due to all the elections that's taking place this year, geopolitical risk, high interest rates, high inflation. The dollar will most probably remain strong and expensive during this year. Only once there's better sight of what will happen to interest rates as interest rates start to decline, especially in the US, and inflation is under control, only then might the dollar starts to depreciate. So the short term, this picture will still continue. The dollar will remain strong. But if you've got a 5-year view, if you look at the long-term cycle, the dollar tends to go through these cycles. It's been strong for 10 years, and it doesn't always, if you look at the chart, the dollar doesn't always stay strong. It goes through these cycles. So we're at the peak. It might remain at this peak for over the short term for the reasons I just mentioned. But if you look at this long-term picture, the next trend is down, and so that will mean a weaker dollar, which is supportive of other developed markets and emerging markets. And then just the rand versus dollar. As I explained, the dollar is strong, and for that reason, the rand is quite weak versus the US dollar. So it's currently trading at the upper band, and there is the possibility that the rand can become stronger. Probably won't go back to the blue line, which is fair value, due to local factors, but there's always a possibility that it can appreciate by about 10%. And that's all my slides for today. So there's a lot of uncertainty built into the markets due to elections, geopolitical risk, high interest rates. But I think one positive is that interest rates globally is still high. So for our clients, that provide a good base. Locally, we can earn about 10% interest rate, and globally about 5%. So that 5% in dollars, 10% in rand that provide a solid base for our clients' portfolio that enable them to take some risk in the equity market, but at least interest rates is much higher than it used to be, and that will enhance the return of all the portfolios for the next 5 years. The previous 5 years, interest rates were extremely low. Globally, it was almost 0%, and locally even it was at 4%. So now interest rates more than double that in local market and 5% higher in global markets. So at least that will provide some support for our clients' portfolio in a well-diversified portfolio. Thanks, Francois.
Sorry, there we go. I just wanted to say thanks for that. We appreciate it. Thank you for everyone for your time today, for being here, for contributing. Thanks for the questions as well. If you have specific topics that you want to address us and want us to address in a little bit more detail, please send them through to us. We'll also try and have Davy here for one of the market call events. He usually has at least one Friday off from his on-bait soccer recordings. Then we'll see if we can get him here to really go into the politics. I know that's usually something that you want to hear more of. But please email myself. You have my email address, or you can email to invest@efpc.co.za with some of the ideas. We would also like some of your feedback. I know when we speak to you, you do give us some positive feedback, but if you want to, please send us some feedback about the market call if it's adding value to you and your clients. We would appreciate that too. Have a nice day. Goodbye, everyone.